Hello everyone, and welcome back to another episode of Simply Wall Street's Market Insights. My name is Michael, and this week we're exploring how agentic AI could reshape just about every industry, from finance and factories to your favorite fashion app. This week we're diving into what these intelligent agents actually do, what's still holding them back, and where the real opportunities lie, whether you're an investor, builder, or just curious about AI. And as always, if you'd like to read the full article, you'll find the link in the description. And if you'd like to skip ahead and not listen to last week's market recap, feel free to use the chapters below. But first, let's talk about what happened in markets last week. Let's start with the big dogs. Big tech earnings smashed expectations. Well, mostly. Amazon beat on both earnings and revenue, but its stock dipped 2% in after-hours trading. Why? Cautious guidance on margins, probably tied to new tariffs. AWS is still the cloud king at $111 billion in trailing revenue, but Microsoft and Google are stealing the AI spotlight. Apple impressed too, with strong iPhone, Mac, and services numbers. Services now makes up almost 30% of revenue. That's a sticky, high-margin growth engine that investors love. Meanwhile, Meta and Microsoft added a combined $500 billion in value after knockout reports. Meta's ad business rebounded, and Microsoft's AI and cloud combo took its market cap past $4 trillion. So what's the takeaway? Investors are rewarding AI-powered, margin-rich businesses, and Amazon might need to turn up the heat to keep up. Now to policy news. Donald Trump's back with tariffs, this time slapping 25% on India, plus an unspecified penalty over its ties with Russia. That could disrupt US-India trade talks and cause pain for Indian IT, pharma, and consumer goods sectors. Also impacted are multinationals that manufacture in India. Think Apple's supply chain and US drug makers. And if secondary sanctions hit buyers of Russian energy, India's industrial and energy sectors could feel the burn. This could shake up ETFs with big India exposure and stir up volatility in firms doing business there. On the IPO front, Figma lit up Wall Street, popping 250% on its debut. That's right, more than tripling Adobe's buyout offer. Valued north of $65 billion, Figma now has serious firepower to challenge rivals like Canva and Adobe. Expect acquisitions, talent wars, and margin pressure across the creative and productivity software world. Meanwhile, the EU dodged a tariff bullet by accepting 15% levies on exports to the US, including cars and pharmaceuticals. It calmed markets, but tilted trade in America's favor. Euro stocks ticked up, but longer term, expect EU firms to rethink strategy, potentially relocating manufacturing to the US. And in a final tariff twist, Trump axed the $800 tariff-free import loophole for other regions. Starting from August 29th, cheap international packages from anywhere will face full tariffs. Previously, this had just been applied to China and Hong Kong, but now it's impacting countries elsewhere. Higher prices could be on the way for those cheaper goods. Now let's dive into the main piece, how agentic AI could reshape entire industries. Agentic AI does have massive potential, but the reality is that it's a work in progress still. Salesforce, which is one of the companies leading the charge into an agentic AI future, recently acknowledged that AI agents still have some way to go. In May, the company published a paper pointing out the high failure rate for agents. The paper cited the most common reasons for failure as context loss, slow responses, hallucinated actions, and most concerning, lack of confidentiality safeguards. In other words, we've got the vision, but the execution still needs some work. There's a big difference between an agentic system that works most of the time and one that's ready to be trusted with important decisions and communicating with customers. This is why the companies supporting the development of agentic systems are so critical. Frameworks like LangChain and Crew AI are making it easier to build these systems, and new protocols are emerging to bring order to the chaos. Anthropic's MCP, or Model Context Protocol, is being called the USB for LLMs, a standard format that lets different AI tools plug and play seamlessly. Not to be outdone, Google's A2A protocol is doing something similar, enabling agents to communicate and collaborate. On the data side, platforms like MongoDB, Snowflake, and Databricks are stepping up. Why? Because, well, LLMs not only consume huge amounts of data, they generate it too. Some data needs short-term storage for context, some needs long-term memory for learning, and nobody's nailed that balance just yet. So where's Silicon Valley placing its bets? According to a fresh chart from Visual Capitalist, model providers like OpenAI, Anthropic, and xAI are still attracting sky-high valuations ranging from $6 billion to $300 billion. Platforms like Databricks are holding their own too, sitting pretty at $62 billion. Meanwhile, companies like Scale AI and Surge AI are racing up the ranks thanks to growing demand for high-quality training data. Then you've got the supporting cast, tools, no-code platforms, and dev kits like Hugging Face and Thinking Machines, all playing key roles in building the AI stack. And don't forget, many of these AI-specific juggernauts are still private. That means venture capital is the one calling shots in this space for now. So now let's zoom out. What does agentic AI mean for different sectors? In the tech and software sector, we're moving from clicking menus to simply telling an AI what you want. It's a user revolution, and it could unbundle entire apps. That means apps are easier to clone, interfaces and backends no longer need to live together, and platforms like Zapier are stitching it all into one smart dashboard. Business models will evolve. Think usage-based pricing, embedded ads, or community-driven ecosystems like Figma's. For solo builders and small teams, the combo of APIs, generative AI, and pay-as-you-go infrastructure is a game changer. That's how Surge AI hit $1.2 billion in revenue before ever raising a cent of outside capital. It's not just possible, it's already happening. In finance, agents will automate underwriting, audits, fraud detection, you name it. Players like Citigroup are already investing heavily here, but legacy systems and compliance risks are real roadblocks. For industrials, agentic AI means predictive maintenance, optimized logistics, and smarter resource use. But adoption takes cash, and the cybersecurity stakes are sky high. For consumer and retail, think ultra-personalized shopping, dynamic pricing, and real-time inventory control. Great for business, but privacy and trust will be constant balancing acts. And in health, legal, and education, AI agents can democratize expertise, offering tutoring, diagnostics, and even legal help. But when something goes wrong, who's liable? Well, that's the question that hasn't been solved yet. So what's the insight here? Any company or individual could launch a killer AI app. Here's the real kicker. It's not just tech companies that stand to win from this trend. Just like Amazon turned its internal cloud tools into AWS, other companies can spin their in-house agents into new revenue streams, especially in so-called boring industries, insurance, logistics, and auditing, where growth is slow but data and expertise run deep. These aren't obvious AI plays, but that's exactly why expectations are low and upside could be high. So, what should investors do? Well, start looking for small, profitable, low-growth companies with domain expertise and a chance to launch their own internal agentic tools. If they nail it, those tools might become entire businesses themselves. Now, if you're curious which public companies could benefit from these trends, you can search AI or data infrastructure on our stock screener. And if you want to go deeper, use our narrative tool to test how these developments could reshape the outlook for your portfolio, especially when it comes to margins, moats, and growth. Whether it's Crew AI powering developers or Databricks shaping the infrastructure, understanding these layers is key. And don't forget, just because something's trending doesn't mean it's priced correctly. Use our valuation tools to help avoid hype-driven decisions. And that's where we'll wrap up this week's Market Insights. As always, if you'd like to read the full article, check out the link in the description. And if you've got feedback or thoughts, we would love to hear from you in the comments below. We'll be back next week with more Market Insights. Until then, invest well.